we focus on alternative assets. We'll show you what investors and entrepreneurs are doing, as well as what's going on in hedge funds, private equity, real estate, and more. Today, we're going to be speaking with a protege of Richard Branson's on how he discovers and develops startups. Plus, an infrastructure industry veteran will join me on opportunities in China and the U.S. And big media's quest to create original content using Hulu as a stake in the ground. So that's coming your way in the next hour. First up, though, we are going to focus on hedge funds and gold because prices are higher for 5 sessions out of the past 6. The most, actually, since 2011. Our markets reporter, commodities guru, Alex Steele, is with me now. So, Alex, so what's behind the buying?
If you're long gold, I got to tell you, hedge funds are very happy. Having a great week. But, you know, some analysts say this is actually just a blip. So here's what went down. Hedge funds raised their bets on higher gold prices for a second week, and that's after Ben Bernanke took away that imminent threat of tapering. He said the U.S. needs, quote, highly accommodative monetary policy for the foreseeable future. So you have more bond buying, low interest rates that can increase inflation worries, then you maybe want to buy gold as a protection hedge. Now, the recent rally also means that gold now reversed most of those losses it saw since mid-June when Bernanke still hinted at tapering. Speculators increased their net long positions by over 4%.
All right, so when you talk to your sources, do most people think the gains are here to stay, or are they expecting a reversal to the mean?
I have to say, I can't find one analyst note that is not somewhat, at least in the short term, bearish on the metal, because short bets are also at a record here. That means a large portion of hedge funds are actually betting on lower prices. Remember, gold is still down 23% on the year. And yesterday, Citigroup lowered its average forecast for 2014, now sees an average of $11.45 an ounce. Managing Director Ed Morse thinks investors are going to keep buying stocks in expensive gold, and that gold is really caught in this vicious cycle. Lack of confidence leads to more ETF selling. Outflows this year already 595 tons on the year, and that leads to more investors selling. So it's hard to get out of that kind of cycle.
All right, what about demand for physical gold? Is this playing a role?
Can that be a savior in any way? Well, somewhat. We have borrowing costs are actually reaching a 4.5-year high last week. Could be a bullish signal, right? Could signal tighter supply on the market. China net imported 106 tons of gold from Hong Kong in May. That's the second highest monthly volume of all time. And Japan's actually buying. That's something you haven't heard in a very long time. The country's biggest retailer will sell more gold to investors than it would buy from them, the first time since 2004. And that kind of demand is really crucial, leading Bank of America to still expect $2,000 gold by 2016, saying jewelry demand could actually be strong enough to offset any kind of investor flows.
All right, Alex, thank you very much. Alex Steele with the very latest on gold. Well, from hedge funds, traders' positions in gold, to one former trader and his fate. Fabrice Touré used to be known as Fabulous Fab. He is the former Goldman Sachs trader accused of misleading investors in order to sell them toxic mortgage-related securities. His high-profile trial is starting today in Lower Manhattan. Bloomberg's Sue Keenan has the very latest. So, Sue, the SEC has a lot at stake in this fraud case, right?
Absolutely. It's the first major case under the new SEC Chairman, Mary Jo White. It's about mortgage securities at the heart of the 2008 financial crisis. And billionaire John Paulson, among others, is expected to testify. Now, when we talk about high profile, check out how hard it is to even see Fabrice Touré in the scrum of cameras that met him at today's court arrival.
Keep it moving.
Good, thank you.
Yeah, how are you doing?
I'm looking forward to be in court and present the case.
Gonna go out?
Yes, feeling good, thank you. I'd love to be able to get to the court, thank you.
Now, one of the things that makes this case really fascinating is that the emails in which the former trader called himself the Fabulous Fab, bragged about being the only survivor that may be left when the leverage caused a collapse, are at the center of the case. And traders also say, there's the fact that Touré's trades, according to the government, were intended to fail. You see boxes of documentation, no doubt with emails and complex trades, being wheeled into court, a hint of what's ahead for the 9 people who've now been picked for the jury, including Deirdre, a female Episcopal priest.
Okay, now, Sue, I want to go back to John Paulson because I heard you mention him. How soon will he be taking the stand?
Possibly possibly today, but likely, fairly soon. Right now, we know opening arguments are underway. There's supposed to be a break around 3:30, and many think that Torre will be on the stand before Paulson. But the SEC's fraud case involves the marketing of Goldman's Abacus investment, which was tied to home mortgages, and Torre testified before Congress that John Paulson's hedge fund picked the securities that went into Abacus. So a key question in this case, did Torre tell investors, and did they know that Paulson was on the other side of the trade? The judge puts it this way: in describing the allegation, Torre handed out Little Red Riding Hood, an invitation to grandmother's house, without telling them the invitation was written by the big bad wolf. Fascinating case, Deirdre.
Thank you very much. Sue Keenan there with the very latest on that former Goldman Sachs trader. When we come back, a venture capitalist who co-founded AOL Ventures and is now running his own firm will be with us. He's going to tell us what he's investing in right now and how difficult it was for him to raise his fund. Also, streaming media causing traditional Hollywood and TV execs to sweat. We're going to show you how networks are upping the ante to compete with Hulu, Amazon, and Netflix. That's ahead here on Money Moves.
First, Bloomberg. First, Bloomberg.
Welcome back to Money Moves on Bloomberg Television and streaming all day long on your tablet, your phone, and at Bloomberg.com. We're following Hewlett-Packard right now. If you take a look, the stock's slightly higher. Word that it's going to be shoring up its board after its April shakeup. So HP has added 3 new directors, including former CEOs from McDonald's and Liberty Media. It's all part of this turnaround effort by CEO Meg Whitman. Year to date, HP shares up around 84%. Well, we're going to stay with technology and investing in the sector because my next guest co-founded AOL Ventures. That's the VC arm of AOL. Prior to that, he was at Virgin Group in the VC arm. He is now independent, running his own firm, Bowery Capital. Mike Brown is with me now. Mike, first of all, welcome to Money Moves. Glad to have you with us. So your firm, it's its inaugural year, so congratulations on that.
Thank you.
I know you raised $33 million in your first fund. We talk a lot about all the money that's sloshing around our fine city.
Sure.
Was it easier or harder to raise that $33 million than you anticipated?
I think it was definitively more challenging. We had 2 major brands behind us in Virgin and AOL prior, so that capital was significantly easier to raise, and this was pretty hard. It's tough out there in the market.
It's pretty hard. And how many LPs, how many limited partners do you have?
Yeah, so we have 5 main limited partners in this fund. It's quite small, and you know, I wanted that from an independent firm just to get myself off the ground and started.
So when you make investments, what is the size that you're hoping to make? We're
generally a seed investor, so I invest at the napkin stage. First money into a business, it tends to be $500,000 on average and very focused on a particular area. Sort of the transformation of IT spend within corporations. And I know something that you've mentioned in the past is that all, let's call them internet natives, so the next generation of technologists basically are now the CTOs, the chief technology officers, they're the CMOs, the chief media officers, even at big corporate tech or non-tech companies. How does this change the way that you're investing and the types of companies you want to put money into? Yeah, I think there's a gigantic transformation happening probably over the next 10 years. As you said, you have sort of this notion of the digital native, the person who grew up with Facebook and Twitter and Pinterest. And so now they're in charge, right? Yeah, so they're just changing the way they think about buying technology solutions, much more cost-effective, much better user experiences, right? They take a literal translation of what they do in the consumer day-to-day using their iPhone, interacting on, you know, Snapchat and all these products and services into their workplace. And so they want tools and services that are definitively easier and more user-friendly. So that brings up an interesting point, because I think in general when there's a user interface for enterprise business, so that is to say software that serves companies versus software that serves people, there clearly is a lag. What is the lag time in your mind, since you know both areas well? Well, I think you've seen the Oracles and SAPs be sort of 5 to 10 years behind in terms of their product cycle. And
Yeah, I
their
haven't seen
development.
Snapchat or
Right.
Oracle's version of Snapchat.
Right. So, and you have businesses like Workday and Tableau sort of driving the innovation and now becoming big companies largely because they provide a better user experience. So we think it's probably a 5 to 10 year play here, but it isn't sort of a 1 to 2 year thing that this is going to happen quickly.
So, Mike, I know that you're focused more, since we're talking about enterprise and the difference between enterprise B2B versus B2C. I mean, you're really focused on the enterprise part, right?
Yes, exactly.
100%.
It's finding the next SAPs and Oracles and Workdays to sort of disrupt the traditional spend that has happened over the past 10 to 15 years.
Okay, so now do you need to look for mafias or drinking buddies? I mean, how are you finding? Because normally the next generation from these larger companies are people who work together at one of them.
Sure. So yes, I think definitively you have a huge ecosystem in the Valley that is very, very approachable and open to sort of newer funds and sort of more innovative ways of investing. I think we fit that bill definitively. So it's very thematic and focused. I'm probably a better thought partner for entrepreneurs. And then we do very, very few things for them. So I focus a lot on the customer growth and getting them early traction with a bunch of companies, essentially.
So you mentioned the Valley, and I know actually when you were at AOL Ventures, you seem to split your time sort of half and half on each coast. Is that the plan as well?
Yeah, exactly. I mean, you're seeing much more innovation come out of the Valley as it relates to enterprise software. Yeah, I think traditionally you have the bigger companies, they're allowing their employees to leave and go on and start these next generation technologies, mostly for B2B software. We don't have that as definitively in New York. You don't have these anchor businesses yet created, but I have a sincere interest in seeing the city grow and enterprise software do better.
Sure, and then there's more endemic businesses, let's call them, here in New York that are probably ripe for disruption. I mean, finance.
Financial services, right? We're in Bloomberg right now.
We're in one of the first ones.
Right, exactly.
Mike, really good to see you. Thanks for coming in.
Thank you for having me.
Mike Brown joining us there from Bowery Capital. All right, well, we do want to bring you up to date. If you are a junk food fanatic, you probably think this is news you can use because Twinkies are back, but they may be smaller than you remember. The owners, the new ones that is, of Hostess have leaner operating costs now that they are no longer using unionized workers. So the cakes may be a little smaller the last time you had one, and the new boxes are going to hit the shelves, listing at 38.5 grams for one cake. Pre-bankruptcy, if you want to make the comparison, 42.5 grams. All right, news you can use. Just ahead, Porsche dealers seeing big bucks in the U.S. We're going to fill you in. Also, Hulu's non-sale, at least for the moment, and what it means for Amazon, Netflix, cable TV, the networks. That's next on Money Moves. For the moment, Hulu stands alone, or at least with its three owners, so 21st Century, previous News Corp, Disney, and NBC Comcast. Now, Bloomberg is reporting that Time Warner Cable may be interested in the online streaming site. Here is analyst David Banks' take on what Hulu's fate says about its competitive position as compared to Amazon and Netflix.
In the longer term, they should definitely be more scared because Netflix and Amazon were sort of trying to move into that space of defining television, disrupting the ecosystem. That's going to be much tougher for them with the existing players owning Hulu.
Porter Bibb is here. He says David is wrong. Porter is the first publisher of Rolling Stone magazine. He's been involved in hundreds of media transactions. He is the managing partner at Media Tech Capital. Porter, always glad to see you.
Good to be here, Medina.
There's a lot of different opinions out there about Hulu. What is your stance?
Well, let's roll the tape back to the beginning of Hulu. Never in the history of media has a group of competitors ever had any success in doing anything facing a new technology challenge. Any of the owners of Hulu, whether it's NBC, Comcast, whether it's ABC, Disney, or
21st Century, News Corp.
They could have overwhelmed Netflix and Amazon if they want. They all have movie studios. They
but
held
Porter,
back
what about
the content.
Coordination? Maybe it's just
Yeah,
hard. I mean,
it's
think
impossible.
about trying
it's impossible.
to. Yeah, I mean, you try to pick a restaurant just with two
That's
other
right.
friends, and it's a nightmare. And
they don't want to give their content over to somebody else. So the movie studios could have done the same thing. When Netflix started knocking on their door saying, "We'll buy your content because we're going to sell it for $8 a month to millions of users," the studios should have said, we could do that ourselves. There's no magic in streaming technology. There are hundreds of companies that provide the distribution capability. But Hulu had two big problems from the get-go. One, they couldn't decide what content each network owner wanted to put into the play. And secondly, when they tried to sell it the second time and the first time, the buyers said, we have to have guarantees that you're going to continue to give us this good content or else we're not going to pay.
So Porter, I mean, do you think that the three owners would let Hulu go for the right price?
No.
You don't think they're going to sell it anyway?
And the analysts who are talking about Time Warner coming in, why would they give that content to a cable company? They're getting hundreds of millions of dollars from retransmission fees right now from cable. Why would they give it to a cable company and say, you can now put it out for pennies?
All right, what about the chances of, I don't know, there's Apple, there's Google, there's Intel. I mean, there's a lot of tech companies that have a lot of money.
And they're all looking hard at the streaming space. You have Apple TV eventually is going to get into it. They've been negotiating with everybody, all the studios, all the networks, and frankly, all the cable companies. Similarly, you've got Intel with their big effort in the set-top box. They've got to have content to put on that box, so they're a player. Microsoft is doing the same thing with the Xbox right now. So there are deep-pocketed partners out there who could make millions, hundreds of millions of dollars for the content owners of Hulu. They're not going to persist in this.
Okay, so they're not going to persist, but you're saying that the three owners of Hulu are just not going to sell, period.
I think what's going to happen is Hulu is going to drift along. It's got 4 million theoretical subscribers and maybe 500,000 to 1 million in the Hulu Plus who are paying. The rest of them are for free. It's not a profitable enterprise. They've talked about putting $750 million back into the venture. That's enough to make it break even next year, not buy any content. And they won't give their content out there. The winner in Hulu is Providence Equity Partners, who was their private equity investor, and they bought Providence out last year. They're out, and they got their money back and made a small profit. Look at Les Moonves with CBS. He did not join Hulu. He's selling product right now, CBS content, to Netflix. He's selling it to Amazon. He's making tens of millions of dollars without being part of Hulu, while the Hulu guys are struggling to keep it alive.
So as far as how old media, and I am putting CBS in that category, can deal with this new world order that we have, it sounds like from what you're saying, Les Moonves is the only one who really stands out as at least having figured out how to make money.
Exactly. It's all about content now, but it's not about the networks. The hundreds of millions of dollars of brand equity investments that networks have put into building up NBC, ABC, and Fox. People don't want to buy the networks. They want to buy the programs, and the programs are what are selling, and that's what Netflix is buying, Amazon's buying, and Hulu is buying.
I mean, to be honest, I think if you ask any person who's sort of 10 years old or younger, they don't even know the difference between a network, cable, or what they see on an iPad that comes through Netflix. Well, it doesn't matter to them.
It's a little bit of a joke, but the networks have become apps right now.
It's a pretty strong soundbite, Porter. Right. The networks have become apps. So it sounds like CBS is the strongest, at least as far as you see managing where we are now.
I think Les Moonves has been the most creative and certainly the most successful in generating revenue out of his content. And where CBS goes right now, I mean, any one of the major networks could set up a viable competitor to Netflix. They all have movie studios under their umbrellas. Why aren't they selling that content? Well, there's one big answer. Because they're making so much money on the retransmission rights that they get from the cable companies that they don't want to give that revenue up.
Well, we'll see what happens with that when we talk about companies such as Aereo. So it's a whole developing novel that we have going on. Porter, it's always great to see you.
It's my
pleasure. Thank you so much.
It's a privilege.
Porter Bibb there with us from Media Tech Capital Partners. So a quick check-in on the markets. I'm going to show you right now. You have the Dow, the S&P 500, and the NASDAQ higher across the board. You can see that there. As far as the groups that are really gaining the most, well, we can give you a quick breakdown here and just show you which ones are in fact moving. You have utilities, financials, industrials, materials. These are the strongest groups. Actually, right now, of the 10 major industry groups in the S&P 500, there are 8 higher, 2 lower. The only ones that are holding back gains include consumer discretionary stocks and also telecom services stocks. So some of the standout companies that we are following for you, we mentioned Hewlett-Packard. That stock's still moving higher. Of course, as we mentioned, you're getting a board shakeup there. You have 3 new board members, and of course, that follows the company's April meeting. Well, 26 past the hour right now. Time to take you out to the newsroom. Bloomberg on the market.
Thanks, Deirdre. Well, we are seeing, as you said, stocks rise, at least to some degree today, on the outlook for potential Fed tapering or not. We had weaker than estimated economic data in terms of retail sales this morning. In terms of individual movers we're watching, the best performer in the S&P 500 today is First Solar. The company seeking approval for a new plant to feed central Chile's grid. Boeing rising after UK investigators said that the fire on the runway at Heathrow was not related to the recent battery problems that the company has had. And finally, Alexion falling after surging Friday on the news that Roche might be seeking financing for a deal. That's it for Bloomberg on the markets. We'll be right back.
I'm Deirdre Bolton. Welcome back to Money Moves, where we turn our focus to alternative assets, places investors are putting their money outside of traditional stocks and bonds. We are going to bring you out to the newsroom. We want to bring you our Bloomberg top headlines this hour. Street Smart co-anchor Adam Johnson has them. Adam.
Thank you, Deirdre. All right, the acquittal of George Zimmerman in the murder trial of teen Trayvon Martin has spurred new calls for federal civil rights prosecution. The NAACP wants U.S. Attorney Eric Holder to pursue a hate crimes case against Zimmerman. President Obama said the jury has spoken, and the governor of Florida says the justice system is doing its job.
We have a great system in our country. We have lots of checks and balances. The federal government gets to make a decision whether they want to pursue something. They'll make that on their own. But look, we have a system in our country that works.
Citigroup profits surged 42% in the second quarter on stock trading revenue and efforts to scale back unwanted investments. CEO Michael Corbett has fired thousands of workers and cut operations in some countries since taking over at Citigroup last October. And here's one for you. Porsche franchises in the U.S. seem to be solid gold for sellers. Since 2010, Porsche has been among the most frequently acquired franchises by publicly traded groups. Analysts say since Porsche has gone from two-door sports cars to SUVs and sedans, it's heightened the interest in owning dealerships. By the way, the Porsche 911 model celebrating its 50th anniversary this year. And the Twitter sphere blew up over the weekend over Sci-Fi Channel's movie Sharknado. The movie generated 387,000 social media comments, but only got, well, about 1 million viewers only, right? We will delve into the waters of social media and the movie Sharknado with director Anthony Ferrante and Sharknado star actress Tara Reid. Lots coming up today on Street Smart.
Adam, thank you very much. Looking forward to it, especially more on Sharknado. All right, well, even though it's July, retailers are focused on the back-to-school season because second only to the holidays, it's the most important time of the year. JCPenney's former CEO, Ron Johnson, made some decisions. Didn't really help the company, didn't really help the stock. New CEO, Mike Ullman, has been at the helm since April. I sat down with Betsy Schumacher, and she runs the kids division. I asked her about the change in leadership and the retailer's newest store-within-a-store concept, Joe Fresh.
Customers have been coming in over the last 10 days since we launched online, and they have photos of the items that they're excited about, and they've been coming in and asking for them. So I think we're going to see some really exciting traffic from this.
So do you think that Joe Fresh Kids is going to be able to drive back to school traffic to JCPenney?
I absolutely do. I think it's a great news story. I think it's a great new fashion, and we're out there talking about it right now.
I took a look at some of the traffic numbers from the second quarter to the third quarter, and it seems the second quarter and earlier there was really a big drop off. It was down something like 15% quarter on quarter, and then last quarter, let's say it was decreased. There was only a drop off of about 6 or 7%. What do you think is going right? And as somebody who's at the top of the children's department, the kids department, what are you doing to help that effort?
Well, there's a few things, right? First of all, it always starts with the product, and I think our product offering is the best that it can possibly be and has been improving over the time frame that you're speaking about in the whole store and specifically in kids. Also, from a promotional standpoint, our customer told us that they wanted us to be promotional, that they wanted to see the value, that they wanted to understand how to come in and see it, and we've been really addressing that both through our marketing and through our in-store marketing.
When you mentioned the discounting, we know that Ron Johnson took it away, and now JCPenney seems like it's having to fight a little bit from behind and offer even deeper discounts than it would have, arguably, had the original promotions and coupons been left in place to begin with. How much is it going to cost you to get back on track?
I think the marketplace has just been highly promotional this year and is really promotional in this time frame. So when we think about it from a JCPenney standpoint, for us, we're at our heritage. We know that our customer wants us to be promotional. They've told us that. We're responding to her. And that's really the way we think about it.
So we've been talking about some of the things that JCPenney has been doing right to win back its customers. What other efforts do you think are paying off and helping to get a little bit of the traffic back?
The other thing that our customer told us was that they were just finding it really difficult to shop. I mean, we had taken a lot of cash wraps out in the last year, and so they would find
people were
things,
waiting online, they wanted to pay, they couldn't find a spot to pay.
Exactly, and they found things they wanted to buy, they just couldn't execute the sale. And so for the back-to-school time frame, we've added back in some portable stations in our stores to make it easier for them to find a place to check out. The other thing is they told us that they were very confused because we'd moved things around on the floor. We've added a lot of directional signage into the store so that they can come in, see where to go, and make it easy for mom to see where she's going.
Betsy Schumacher, head of the kids division at JCPenney. When we come back, how to invest in some of the biggest infrastructure projects in China and the U.S. More on that subject on Money Moves in just 2 minutes.
First, Bloomberg.
Welcome back to Money Moves on Bloomberg Television, streaming all day long on your tablet, your phone, and at Bloomberg.com. Earlier, we got new GDP data from China, so growth slowed 7.5% in the second quarter. Our next guest says infrastructure development, though, is still a top priority. Michael Underhill is here now. He is the co-founder of Capital Innovations, an asset management firm that focuses on infrastructure, timber and agriculture, other kinds of assets as well. The firm has about $1 billion under management. Mike, always great to see you. Thanks for coming back. If the average investor does want to make a bet, wants to put some money to work on infrastructure in China, what's the best way to do it?
Well, playing infrastructure in China is such a challenge yet an opportunity. You've got direct investment, fund investment. I think for the average retail investor, publicly traded securities provide safety, liquidity, yield, and transparency. A company like Guangzhou Railway, ticker symbol GSH, gives you core capital growth plus income, the ability to capture some of the dynamism of growth of transportation and of infrastructure in China. You look at Chinese New Year, roughly 176 million people rode the railroads in China. So core capital growth plus income, a great play for publicly traded listed infrastructure in China.
If we look a little closer to home, what about here in the U.S.?
Well, I think in the U.S. you see a preponderance of opportunity. By that I mean you have publicly traded stocks. You have not only transportation, but energy. When you look at energy independence in the United States and the ability to invest in things like energy infrastructure, it's phenomenal, it's exciting. You see things like master limited partnerships. I look at master limited partnerships last year. In the U.S., you had roughly $30 billion worth of equity that was issued in master limited partnerships, just in the public markets alone. Mutual funds, exchange-traded funds, separately managed accounts for the individual investor, as well as institutional investors are spending more time in master limited partnerships. So you see things this year, we're on track to do $34 billion, so more than 10% growth of issuance in equity for master limited partnerships.
So you mentioned some of the energy opportunities. Are there one or two that stick out in your mind?
Well, I think when you can get some flexibility, not only play the dynamism of the commodity markets and energy with a master limited partnership structure, but also have a dominance. Names like Plains All American, ticker symbol PAA. Great name, core capital growth, high yield, but the yield is tied to that inflation throughput on the underlying commodity. And when you look at a world in which people are trying to postulate what's better, oil by rail or oil by pipeline, PAA has actually taken a very proactive approach in actually purchasing stations, facilities, so they can actually participate in the dynamics. In the last year and a half, you've seen oil by rail car increase by 167%. So PAA, great play for the individual investor.
All right. I know that you're also looking along with infrastructure, so sort of transporting goods to the world, but then also agriculture, feeding the world. What kinds of opportunities are you looking for in that context?
Well, I mean, it's a great question because we look at things like essential services, food, forests, and fuel. Fuel is the infrastructure. We talked about that. You look at things like food, agriculture, population demographics and growth in not only emerging markets, but demographics in terms of shifting dietary patterns, changes. You know, the single
There's
best
a growing
way
middle class, we know. More and more people want to eat beef or at least meat, and that's been a shift in a lot of places in the world.
Absolutely. And it's not just China, it's not just India, it's not just Brazil, but you look at the N11 countries and their consumption patterns and trends. Protein, to meet the world's population growth, we have to increase protein output by 75%. The single best way to increase crop yield, 75% growth metrics, you need fertilizers, potash and nitrogen-based fertilizers. So I look at a company like Mosaic, you look at free cash flow, you look at the ability now to address some of the issues. Last year we had record droughts. This year we're having record cold and then record wet weather, and now we're seeing this heat in New York and elsewhere in the U.S. Fertilizer is one of the single best ways to increase crop yield.
All right, you mentioned feeding the world, and then also obviously we're sort of on at least a national theme. What about housing? We've been talking bigger picture view on the U.S. housing recovery. Do you believe in it? And then if so, how do you invest for it?
Well, I think, you know, not only do I believe in it, but when you see companies out there, friends like Steve Schwartzman at Blackstone, you know, putting that kind of money.
Yeah, they're the biggest landlord in the U.S.
They
right
are
now.
the biggest landlord.
Yeah.
And they're one of 2 or 3 leading private equity, some of the smartest money out there, and they're putting money into homes. You have 115 million residential homes right now. You look at the market and recovery, you were trending towards 1 million plus new housing starts. But the remodeling market, existing home sales is up, prices are up. So this portends a broader-based economic recovery. And I see not only housing recovery, remodeling recovery, but companies that are benefiting from it. Weyerhaeuser is a great example. They're playing on the housing growth with lumber, timber, OSB, wood products, but they're also shipping logs to China and Japan. Japan has overstimulated its economy. It's now in second phase growth. They're actually consuming wood products, building and remodeling. That's created a wealth effect. So companies like Weyerhaeuser, they benefit from A, the housing trend, and B, global growth dynamics, consumption trends and patterns in China and Japan.
It's pretty hard, isn't it, to invest directly in timber? I mean, you're giving us a way to do it through a public stock, but I mean, otherwise, this is a pretty hard thing to pull off, right?
Well, I think when you look at it, it's illiquidity. You have to take a look at, are you willing to take the illiquidity risk like a Harvard or like a Yale? But more importantly, beyond the illiquidity risk, are you willing to take the concentration risk? You're buying attractive timber. You're concentrated by species, by geography, and by species I mean spruce, pine, fir, Brazilian eucalyptus, New Zealand radiata pine, where you could get in a Weyerhaeuser and get global exposure by species, by geography, and it's very well diversified as opposed to a single private equity play or a single private TIMO, like a private timber fund investment.
Okay. Mike, always glad to see you. We're happy for the ideas. Mike Underhill joining us there. He is the co-founder and CIO of Capital Innovations. When we come back, expanding your investment vocab with Bob's buzzword of the day, convertible arbitrage. Bob says he can't believe that we haven't done this yet, but we haven't. It's coming your way in just 2 minutes. Welcome back to Money Moves. Time for our daily buzzword, one investment term to improve your alt vocabulary. Bob Rice is here from Tangent Capital Partners. Convertible arbitrage. Bob, you said you can't believe that we haven't done this yet, but we haven't.
Right.
So explain the strategy, please.
Well, it's such a classic. It really is. But first we have to start with what a convertible bond is before we can get to the arbitrage part. So convertible bonds, kind of interesting, important part of U.S. history, believe it or not, because these are the things that really financed the railroad expansion in the 1800s. They're like a regular bond, except for one really cool feature. Say it's a $1,000 bond. At the end, you as the holder can say, well, I want my $1,000, or you can say, you know what, instead of the 1,000, give me 10 shares of stock, or whatever predetermined number was in the stock, was in the bond when you bought it.
So basically, if the stock price goes up, then obviously the holder can say, okay, I'll take the stock goes up, and I benefit.
Right. It's got a huge upside as compared to a typical bond. And so the investors like that part of it, and the companies like it as well. Because they are conveying that benefit to the investor, they're able to lower the interest rate that they would otherwise have to pay on the bond, so it's cheaper. And even if they wind up having to issue the stock at some point down the road, it's going to be by definition at a higher price than today's stock, so they're suffering less dilution than they otherwise would have.
So where does it get interesting? Where is the mispricing that makes this flexibility interesting?
Yeah, so it's kind of a win-win-win so far. And where does the arbitrage come in? It comes in because that option value is really, really hard to price appropriately, and especially on original issuance of these reasonably illiquid bonds. A lot of times that option price is probably, the inherent price of the option is probably higher than is reflected in the price of the bond. So what the arbitrageurs do to take advantage of that is they say, okay, great, they buy the bond, and then they sell an offsetting amount of the company's stock at the same time.
So in that case, then, for example, that person wouldn't really care, I shouldn't say it that way, but in which direction the stock goes.
No, exactly, that's right. So the idea is by doing that, they've captured the extra value that they really believe that the option has and that's embedded in this bond. Doesn't matter whether the stock goes up or down. Now look, of course, it's a lot more complicated than that really, because you have to look at, well, hey, gee, but you're shorting the shares, so that costs money. You've got income from the bond. The value of the option does bounce around every time you have to rebalance the trade, but that is the basic idea of convertible arbitrage.
All right, and funds that are using this strategy, how have they performed?
Great. I mean, in a word, this is one of the reasons that it's important to know about this strategy, because it really does perform very well. It's been one of the very best performing strategies over the last 10 or 15 years, except for one time, that 2008 thing. So in a real panic, these don't do well. But in just normal market sell-offs, they do quite well. And it's something, so you can't shoo away the black swans with it. But otherwise, it's a very good strategy for investors to take a serious look at.
Convertible arbitrage, there it is. Bob Rice, we thank you as always. Bob Rice joining us there from Tangent Capital Partners. And remember, if you have an idea for Bob's next buzzword, you can go ahead and tweet it to him at BobRice3. We are going to be bringing you more next on Trade this afternoon. The day's major market-moving headlines straight ahead on Money Moves. Tomorrow on Money Moves, veteran angel investor Joanne Wilson, where she sees the most promising tech companies, why more angels are looking to invest in women entrepreneurs, also the evolution of hedge funds. Well-known investor Simon Lack of SL Advisors will join me. He's going to tell me about the changes that he is pushing for in the industry. So all of that coming your way tomorrow on Money Moves. In the meantime, though, it is 56 minutes past the hour. Time to get you caught up on the markets. Our senior markets correspondent, Julie Hyman, has the latest. Julie.
Well, if you look at stocks and where they stand right now, we're seeing them pretty much at the highs of the session. Not anything like a runaway gain today, but we are seeing the S&P and the Dow at records, and that's on the back of some some mixed economic data, enough for the Fed to keep going with its stimulus. Take a look at what's going on with metals and commodities today as well. Copper is actually lower, a weak spot today after China said GDP grew 7.5% last quarter. That is slowing momentum. Oil has been a little bit all over the place today because of mixed economic reports, but at the moment we are seeing a gain for oil. And gold up for the 5th time in 6 sessions on the outlook that the Fed will keep stimulus going here. And so gold is gaining to some extent. Also, we're talking telecom in today's sector report. The battle for bandwidth continues. We're talking about AT&T and its purchase of Leap Wireless. That deal will give the nation's second largest wireless carrier 5 million new customers, as well as more airwaves. For more on what this means, let's bring in deals reporter Christina Alessi here in New York. Christina, so why does this make sense for AT&T? What's attractive about Leap Wireless?
Well, look, Julie, at this point, it's all about getting more spectrum. That is, you know, AT&T, along with Verizon and the rest of them, want to be able to provide consumers with more data, faster data. It seems like that is where the future lies for these companies. And, you know, AT&T, for the most part, has been a little bit behind the ball. If you remember, about a year ago, they tried to buy T-Mobile to fix that problem, to get more spectrum. The government shot it down for regulatory reasons, and now it's going after the smaller players in an attempt to catch up, but it's also ending up having to pay up as a result.
Well, and speaking of paying up, if you look at Leap Wireless today, the shares are actually rising above that $15 offer price. So it looks like investors maybe are looking for somebody else to step in.
Well, part of that has to do with, as part of the agreement, Leap is actually selling some assets, and the proceeds of those sales will actually go to investors in Leap. So that the real rise you see there has to do with investors factoring those proceeds in. But that hasn't stopped analysts from speculating that T-Mobile may jump in here. Of course, people said that perhaps T-Mobile was around this even before the deal was announced, because there was an 88% premium over the closing of on the stock the day before, Julie. So big money there. You know, we could see another bidder jump in at some point, but this is definitely going to force the number 3 and 4 to definitely do more deals, and we could see some consolidation along the way.
All right, more telecom consolidation on the way. We've already seen quite a bit. Thank you so much, Christina Alessi, our deals reporter. That's it for Bloomberg on the Markets. At this hour, we'll have the latest market stories and data every 30 minutes at 26 and 56 past the hour. And up next, we've got Street Smart.